quantitative capital standards, as well as the parts that address Pillar 2 and Pillar 3. Clearly, let me just make two observations of my own personal reflections, and then I'll let you continue with the debate. The first is, what seems to have happened at the international level is we seem to have been in what I would call an extreme example of the European way of doing change. That is a very long period of stasis where absolutely nothing happened. I'm exaggerating slightly, but only slightly, followed by a very short period of time when we turn the world upside down. When we have radical step change. And my reflection is that the US political economy, which is much better at delivering and much better at coping with a series of gradual incremental improvements, I think the US political economy will have the greatest difficulty agreeing with that, cooperating with that, digesting that is my first thing. My second observation is on the comment that Terri was just saying a few minutes ago about market consistent valuation. For me, one of the great lessons of the crisis, it was a lesson before the crisis, but it was relearned, is that financial stability is often promoted by there being a sufficient number of people in the system who do not do what is privately rational, particularly do not do what is privately rational during periods of crisis. And counterintuitively, though it may seem, actually getting everybody to do the rational thing can be a source of financial instability. And that, I think, is the next great challenge for microprudential regulators, be they banking regulators or insurance regulators, because as we improve risk management, as we improve the ways in which insurance companies are run, if indeed we are improving it, might be Terri's response, but as we improve that and make the insurance companies individually more privately rational in their risk management, we are not necessarily making the system more financially stable. Having said that, my ideal world would be where my insurance company is privately rational and somebody else's is the one not being privately rational and providing the financial stability. And that is, I think, the great challenge of insurance regulation.
Yeah. But I think, Paul, that one of the lessons from the financial crisis indeed been that models are not perfect. And people have to realize that if they use models, that they are in charge of the models. And that models are often based on irrational behavior of people. We've also discovered in the financial crisis that people don't necessarily act rationally. So I think it's very important that if you design a system where you use market consistent valuation, that you also have a system of proper supervision. And I think in the financial crisis, the proper supervision did not apply. And one of the disadvantages, Terri, of fair value accounting has been that people have interpreted fair value in the wrong way. A lot of people considered fair value as profit, which of course it is not. And so people that shoot at fair value rather than to shoot at a behavior which is a short-termist approach, because people want a short-termist approach. And that, of course, is a problem also in the insurance industry. But to come back on your international issue, Paul, it's obvious that the way we are looking now at financial regulation after the financial crisis, that it has to be a cooperative exercise. And that explains why there is so much activity today, because there is a political drive, and the US is part of that. I mean, the US is part of the Financial Stability Board, the US is part of the G20 and signs the same agreement. All countries in the world have agreed to do that. We may not like it, but that's a fact.
Okay.
Go on.
Yes, thank you. I think you make an excellent point, Paul, that these improvements may make the system less stable. And this is this may be one of my greatest concerns, that the ability of the insurance industry to serve the function it plays demands resilience. It is able to take new kinds of risks, cyber risk. It's able to take tail risks in catastrophes because it thinks about risk, and because when something goes wrong, it's able to manage through that process. And there are a variety of ways that it can manage through the process. I have one of my kind of talking points in recent years has been that, well, let me back up. Let me tell you about a little history on banking in the U.S. 1918 banking panic. Federal Reserve was created to solve the problem so it would never happen again. 1930s Great Depression, FDIC was created, Federal Deposit Insurance Corporation was created to solve the problem so it would never happen again. Then we had the Latin American debt crisis, Citigroup was bailed out, new capital requirements were put in so it would never happen again. Then we had the savings and loan crisis, new requirements, banks bailed out, new requirements put in so it would never happen again. And then we had this most recent financial crisis, and now we got Basel III and we got all this stuff, and so it'll never happen again. Call me skeptical, but that's what I am. I just don't believe this, it'll never happen again. And so I come at this saying the banking sector doesn't have the answer. The banking supervisors don't have the answer. We know there's a problem, how do you regulate internationally active groups, but we don't yet have the answer. So we ought to be thinking about our own answers, and the banking sector is sort of struggling through their own issues. I don't know what it is that makes our sector resilient, but it is. No, is it the structure? Is it the diversity of requirements in the industry? Is it the healthy attitude toward risk? There are a whole bunch of moving pieces here. And we're talking about stepping in and dealing with something with the potential to muck up this critical feature of the industry, which is its resilience. I think we got to be very, very careful about micromanaging the risk culture of this industry, which seems to be working for reasons that we don't really understand.
So Terri, you've said something very interesting, which has always struck me as a great cultural divide amongst insurance regulators across the world. Some insurance regulators believe that the insurance industry and the insurance business is inherently resilient. Others think that whilst that might have been historically the case, that it probably is not the case today because of changed markets, changed circumstances, and that the extrapolation from the past to today is suspect, and the insurance industry is not resilient, notwithstanding that we haven't seen the kind of banking crash. And that informs the difference in the dialogue when people ask the question, what problem is one trying to fix by the insurance reforms? I want to move us on now and ask a different question to you, Carol. I now am in the private sector helping insurance companies try and make sense of the confused and confusing dialogue that is insurance regulatory standard setting. I am sure that quite a number of people here will be asking themselves the question, my goodness, we're doing a huge amount of preparation for Solvency II. How long is that going to endure before significant parts of Solvency II, if not the entirety, are replaced by a global standard? I mean, I can tell you as a managing director in Alvarez and Marcel, that's what people are asking me. What's your response to that?
Well, my response to that would be that Solvency II, in the way it's designed and will be implemented, is a risk-based solvency regime that is quite advanced. If I listen to Terri, I have the feeling that when we go for an international capital standard, that it'll be below. I cannot imagine that the standard will be higher. So I would presume that the companies that apply Solvency II will have no difficulty with the international capital standard. It may be little tweaks. But I can't imagine. I mean, you can't have a risk-based solvency regime and another risk-based solvency regime. You either have it or you don't have it, basically. You may not want to consider all the risks. You may have a different view about capital. But I don't think that from a European perspective, I would be afraid that the international standard would require us to do it all over again.
Now, Terri, I want you to have the last word on capital, and then I want us to talk about non-capital aspects of insurance regulation. How similar or different would you expect the global standards to be to Solvency II?
Well, my fear is that they're heading towards Solvency II. I do think that in the short run, they're going to be, actually, I take that back. I don't think that's right. I think in the short run, they're going to have to make something that
I was hopeful. I was
yeah,
hopeful.
I know. In the short run, it's going to be fairly, they're moving toward a factor-based approach for the BCR. I think that's personally what I've seen of the BCR, that's probably a pretty good place to stop for a while. That would be, for me, good enough for the ICS for a while you kind of work through. What I am fearful of is the IIS going down this road of trying to use the capital requirements to create a level playing field. And that's where I see them headed in the long term. I hear a lot of talk about comparability and level playing field, and the markets are so different. There is no way, I'm just going to put this stake in the ground, there is no way you can get to a level playing field through a uniform global capital standard. It's just not going to happen. So again, I come back to the goal of supervision is to identify potentially troubled companies where you need to intervene, use this relatively blunt, not relatively, very blunt instrument